Hello, everyone, and welcome to the NCI CreditWise Academy seminar series, the first session of 3, Navigating Credit with Confidence. The first session will look at Credit Management 101 and give you the practical skills in challenging or the challenges of credit risk management, and hopefully we'll give you some tips along the way. I'd like to welcome Prudence Chang, who is co-hosting this seminar with me. My name's Kirk Cheeseman. I'm the Group Managing Director of NCI, and it's great to have you along for this first session of 3. So the whole idea around the CreditWise Academy was to give credit managers and credit officers and people involved in credit some tips and tricks around credit management. And as we go through the various series or seminars, we'll logically follow the flow of credit management. And overall, we want to give you, empower your minds and inspire excellence with the top tips that we've learned along the way in working with loads of clients in how they handle credit risk. So just quickly, who is NCI? So NCI was established in 1985. We're a specialist credit insurance broker and also offer other credit services. We have an APAC presence and global capability. We are the leading specialist trade credit insurance broker in Australia and New Zealand. We're part of the listed company Steadfast Group. We have over 3,500 clients. And we're talking clients in steel, building and hardware, timber, electrical, advertising and media. So we cover a broad range of different sectors. And we also have a fully integrated system which offers a database of intelligence for our customers as well.
Thank you.
But I'll hand over to Prudence to give you a little look at why you should offer credit terms to your customers.
Thank you very much, Kirk. As Kirk explained, we have the fortunate ability to be going into so many different industries and seeing their best practices moving forward. What we are noticing is more differences in industries and terms, and really, more consideration for offering services and goods on credit. And I think this really is going to be very important moving forward as we do adapt to different changes, and certainly when we want to be growing the business, of course. So offering terms can strengthen relationships. It certainly can build the trust between debtors and yourselves, but it also brings trust and it secures relationships between sales and accounts. We come across so many businesses where there isn't that strength within the relationship, but accounts, of course, can be seen as a growth maximizer department. And certainly by growing into terms and relying on accounts to be supplying such information can really help the business grow. As I said earlier, this builds customer loyalty as well, because as much as we want to be supplying goods and we want to have payments up front, which COD is of course king, by allowing that further term of payment and that flexibility with your customers, it can of course increase that loyalty. This also can strengthen your market position. A lot of competitors that we see with clients, they can be offering additional terms to their customers. It might be extension of terms in relation to additional product lines or some projects. So this can, of course, strengthen your market position because it does build that loyalty, as we mentioned before. Of course, this does provide cash flow solutions for prospects and clients. And yes, they are kind of using you as a bank, but it's really important, as we said at the start of this, to be opening up the accounts effectively. And that's what today's session is really all about.
Thanks, Prudence. So in my mind, credit managers and the credit teams within businesses are the business's superheroes. I know that sales in particular get a lot of credit for what they do, but collecting money is just as important as selling goods or services in the first place. There's a little QR code here, which is an article I wrote around being your business's superhero. If you're a credit manager or a credit clerk, credit officer, click on that link and have a look at that article where it definitely gives you guys a lot of credit for what you do. So what are the key elements of credit risk management? Well, the first thing that you want to do as a credit officer or manager is mitigate financial loss for your business. Now, of course, we can't always pick the right winners or clients, and there are bad debts that do happen throughout the year in many businesses. But if you can start by setting a foundation within your business to avoid bad debts and pick the right customers to deal with, then that is one of the key elements we'll run through today. Ensuring that your terms and conditions are robust and that you have systems in place to make sure that when you first onboard a customer, that you have the right terms and conditions in place to, if something does happen down the track and you do need to rely on those terms and conditions that you've offered your customers, then make sure that you have them in place when they first sign off on them and you offer credit. And we'll be talking a little bit about those shortly. Enhancing decision making. So as a credit team, you'd be looking at different ways that you will offer credit and how you will assess a debtor and onboard them and what credit terms and credit levels that you will be offering your customers or prospects. And we have a typical matrix that we'll run through later in this seminar of one that is a typical matrix of what our credit teams may use. And of course, protecting your business allows you to offer growth and grow your business and sales by offering those credit terms and extending credit to those good customers, perhaps beyond what you would normally do if you didn't have these robust processes in place. So the whole whole cause of a credit team is to make sure that you're protecting and supporting growth of your business. You definitely are a superhero.
Thanks, Kirk. So some questions to really ask yourself about how your processes and procedures are being run. Firstly, do you know your customers? It's really interesting when we walk into businesses and we look at their age trial balances, we look at all of their businesses that they're actually dealing with on their debtor ledger. And it is almost outstanding to know that 27% of the businesses that we see, their debtors are actually incorrect entities, which this is, of course, a huge problem because if we are invoicing the wrong entity, it means at the other end, when we're trying to collect debt or want to go down collections or legal route, it makes it really, really difficult. So I always say to people, do you actually know who you're dealing with? And in that, are you monitoring this debtor for changes in their business names, their ACN, ABN numbers? It's really important to have that picture being looked at frequently. How are you actually offering credit terms? Are they flexible or are they on industry standards? We often go into businesses and we're able to talk to you about how your credit terms are against other businesses in your industry. And it's really important, of course, to make sure you're at market level because that will increase the growth within the business and make it a level playing field. How are you capturing new client information? So how are we saving it and how are we actually engaging with that process? So when we're capturing this new client information, such as the adverse reporting or maybe some other information such as trade references, are we actually keeping these on file and looking at these regularly to make sure that picture hasn't actually changed? What assessment process are in place to manage these new clients? So are we simply just looking at trade references? Are we going the next level up and ordering adverse reports? Are we looking at banking reports and finances? And as Kirk said, there is certainly different levels of exposure that more is, of course, necessary. I tend to believe that trade references, unfortunately, aren't always the best way to be assessing customers because a debtor should give you 3 good trade references. Now, number 5, who within the business makes the decision if credit is actually offered? Now, sometimes this can, of course, be credit managers, but it can actually go up the chain. What does that mean for your process? Does that disable you from making decisions in a really quick manner? Or does there need to be more processes at the start to allow you more confidence in actually making those decisions, such as I said, not just doing trade references, but using other forms to really understand the financial worthiness of a customer? And what terms and conditions will your customers actually accept? So we used to, put out a credit application form and always demand that a guarantee was going to be signed. We know in the Australian market that unfortunately not all guarantees are signed and people aren't happy with it. So what other security can we put in place, such as maybe the PPSA, or can we change new terms and conditions within the credit application form to put you into a better position? And as the red says there, every business has its quirks. It depends on your industry, your size, and your internal structure and what can actually be possible. We also need to take into consideration consideration what the risk actually looks like if we are taking on pre-credit risk. So are we ordering goods prior to invoices being actually issued? Do we have consignment stock? And what's the risk around that area? And are we actually bringing in specialised products also for our debtors? All of these things need to be taken into consideration to really look at our processes and make sure that we have the most robust ones possible.
So essentially, Prudence, what we're saying here is that it's best to have a great foundation, a proper credit management or procedures guide, and a way of onboarding customers, which is going to give you the best assessment tool to help in the event of non-payment.
Yes, absolutely.
All right. Before we get into the tips and tricks and some of the examples that we have, let's just have a quick look at where we're sitting at the moment as far as insolvencies go. And the reality is that not all customers will pay you. And that's why credit managers, credit teams exist, I guess, is to make sure that you're getting the best odds of making sure that a customer is going to pay you, or if they don't pay you, how do you recover those debts? So if we look at the past history in Australia, and this also is reflective of our friends in New Zealand as well, in the way that we've seen insolvencies, and this chart goes back to January 2018. The red line is companies entering external administration here in Australia, and then the orange line is the claims that have occurred, being credit insurance claims based on insolvencies that have happened with NCI. So when you look at the red line in particular, you can see that the average sort of insolvencies that happen is around that 600 mark. We saw that pre-COVID and the pandemic. And then when we had the pandemic actually come into play, and initially we had a bit of a jump in that first quarter when everybody thought that maybe perhaps given the terms and conditions and or the environment, and given the fact that businesses weren't able to go to work or be on site, that we would see a lot of insolvencies. But with the government support around the world and the amount of cash flow that went into the supporting businesses, we actually saw a massive drop-off in insolvencies down to levels that we've never seen before. And at the beginning of 2021, the lowest it got to was 200 insolvencies in 1 month. Now, this continued along the way and really until the first quarter of 2022. And then we saw some pressures come in again, perhaps, businesses that were a little bit more lenient in collecting or taking action on overdue debt started to say, you know what, we need to start to get this money that was overdue. And that flowed through and we saw an increase in insolvencies throughout 2022. But then the economy did struggle a little bit more. Interest rates started to go up, and this is during the beginning of 2023. And then there's been a steep jump in insolvencies in Australia and New Zealand, especially in the building sector. The residential home building sector really saw that impact of the massive shift up in building approvals. And then we had the big inflation on products and labour shortages that then caused an issue. And that flow through of insolvencies that didn't happen during 2020 and 21 started to occur. And that's continued to the point that now, leading into the last quarter that we had, calendar Q2 of 2024, we actually saw the largest number of insolvencies occur in Australia. And that trend, unfortunately, I feel is going to continue on for the remainder of this year. One, because of the wash up of insolvencies, and two, because of the financial pressures that businesses are under and that consumer spend is starting to slow or is slowing even more. So with that peak, credit managers and credit teams actually become more important to, one, make sure that you're selecting the right customers to deal with, reviewing the credit risks that you have in your book at the moment, and making sure you have robust collection processes in the event of non-payment or insolvency. So that's probably a bit of a shaky look at the current economy, but let's look at, Prudence, what you can do to make sure that you build that foundation to ensure that you've got good credit practices to make sure if you have a bad debt, you've got the best case of recovery.
Absolutely. Thank you, Kirk. So the first one, as I discussed before, understanding your customer's needs is really, really important. We can try and dictate as much as possible, but if it's not a marriage that is working, it becomes awfully difficult. So one of the things that you have to do, of course, in assessing these customers is assessing the customer's creditworthiness. There's so many ways that you can do this. And as I said earlier, depending on the size that you actually want to be looking at, often we see customers layering out these ideas. So whether it be through trade references, ordering those reports, as the company has larger credit limits being requested, you might want to look at financial analysis as well. We want to analyse, of course, during this process of the customer's payment behaviour as well. So during the course of actually dealing with a debtor, I always say to people, look at the customer, have a look at to see whether they ebb and flow, and maybe there's reasons behind that. That will better allow you to analyse the customer and how they're actually going to be paying you. Of course, in that, they may wish to have tailored terms to industry standard, and the customer might have certain profiles that they actually need to have done as well. It also might be project by project. So it's something to consider also, is that having that flexibility in those terms of payment. Establishing clear policies is something that I'm very, very passionate about. Often I find that if debtors understand where your mechanisms are in regards to collection actions and days in which you might engage in this, or legal actions, it can actually help you in building that foundation for opening those accounts. Because if they understand, then the engagement is obviously a lot easier. In that, we also really want to define the credit terms and the limits that we are actually setting. If it is a smaller limit than what the customer actually wants, a good idea is to talk to them about it and say, okay, if you give us these 4 payments, and if they're up front, or if you are able to stick within this time frame, we could move it up by whatever percentage. So still allowing that customer the hope that they are going to get that credit limit if they stick within what you actually require. We want to set out, of course, the payment due dates and the early payment discounts if there are any, because that, of course, will enhance the relationship with you and your debtor and hopefully make them pay earlier, which, of course, increases your cash flow and therefore increases the growth to the business. You also need to really outline any penalties if they actually are going to pay overdue, because this, again, will hopefully trigger them to be paying a lot earlier. We've got the risk assessment there, which is another foundation that we obviously want to have a very good understanding of. We want to conduct our credit checks and financial analysis through strong parties. There are a couple of different parties that you can obviously use. Each party does have their industry specifics that they are very good at. So it's important to align yourself with a partner that is going to give you the correct and most up-to-date information to do this. We want to be using strong credit score models as well. These models can be by industry, but we can also help you in setting those out. You want to monitor economic and industry trends as well. So if you are in a certain industry, you might be able to see any changes that could cause changes within your customers' behaviours. Google Alerts is fabulous for this. So if you do have top customers, put them into Google Alerts so that you can actually watch what's going on. Legal and regulatory compliance is, of course, a really important one, which unfortunately our government isn't very good at educating us in a very fast manner. So it is, of course, important to be aligning yourselves with people that are able to tell you of these changes before they actually occur. We've then got to ensure that we have compliance in our contracts and in our credit application forms to make sure that we are actually setting the standard for these. Draft clear and enforceable credit agreements, and I do recommend for you to have these looked at least every 12 months, if not every 24 months, because as I said, things can change quite dramatically to do with legislation, which may then change what you have written in these applications. Stay updated on these changes in credit regulations and make sure that if you haven't gotten them checked, you are, as I said, doing it quite regularly. Communication and transparency is a huge part to the foundation of opening up accounts and really understanding where you're going to be sitting in the relationship. We want to clearly communicate any changes to terms and why they are being changed, of course. We want to provide detailed invoices with payment instructions. A lot of invoices that I come across might have 30 days on it, but not a date. Now, of course, we need the date to ensure that we know when the 30 days is going to be occurring. So those simple things, when you look at an invoice, they need to be clearly set out. I often say to people, let's bold them. Let's make them really enhanced so that then the debtors actually see when they're meant to be paying you. And of course, open up all lines of communication in case any disputes need to be resolved. Now, regular review and adjustment, as I said earlier, we want to be looking at these quite regularly. We want to be adjusting any terms and conditions to your favour to make sure if you do collect any debt, or you're going into collections rather, that you actually have mechanisms in place to not be paying for any collection or legal fees. Technology and automation is a great way to actually keep on top of all these things. There's a lot of great software out there that can help you in not only collection of debt, but making sure that you're opening up accounts in an automated way, but ticking all those boxes that you need to during your actual credit process. We want to be making sure that we're implementing real-time credit monitoring tools. So it's not just we open the account and we don't watch them, we don't see them, we don't know of any changes. Put something in place so that you actually are watching these debtors on a regular basis so that you are upfront and you actually know everything that's going on with who you're actually working with. As we say there, building a solid foundation for credit terms involves a mix of different things, but having all of these things in the discussion and in the toolbox will put you in the most favourable position should you have to collect your debt through, as I said, that collections or legals route.
Yeah, exactly, Prudence. And what we see that when a credit team or a credit function within a business sets a clear vision, like you said there, I love that vision statement. Building a foundation for credit teams involves a mix of careful assessment, clear policies, effective communication, and regular review. That would be, I guess, the top echelon of what we see with various businesses that put these visions in place and have a credit procedures manual that they follow so that when they have things pop up within their business, they can refer to this manual, they know what the rules are, they know what they're going to do, and they have a clear path and templates of a way to do it, which we would say is the foundation of building a credit assessment within your team.
And I should also mention, Kirk, within that, it's a really good idea to put these into, a cheat sheet almost for your sales teams as well. So they can understand if something does occur, what your reactions would be in case they also need to manage that customer relationship.
Yeah, you raise a really good point. And quite often you can see a barrier in businesses between the credit team and the sales team. And you quite often hear, oh, well, the credit team's to stop me doing sales. In fact, if the sales team and the credit team works a lot closer and they can work on how to get the information that they can make quicker decisions and better decisions and larger decisions, then obviously the sales team are going to be able to sell more. And that would be a benefit to everyone, the company and the sales team.
Absolutely.
I put here a slide which is a sample credit risk assessment matrix. And it is a very basic matrix, but it's where we see various businesses take on board a matrix and work to it so they know what they will be doing to make an assessment on a particular customer. So this is an example where you have a new customer that's coming to you and they fit within a certain amount of credit level that they're looking to gain from you, that you will then look to assess within your own matrix. So I'll quickly take you through the different levels and why we're suggesting various assessment tools or information, and then I'll have a comment of what I think you should do beyond that. So when we look at the first layer there, if a customer comes to you and says, we would like a credit limit of 0 to 10,000, well, probably the most appropriate thing to do is to get a quick, clear adverse check. And one of the elements that we look at when we're assessing credit on behalf of our customers is to make sure that they've been around for at least 6 months. Now, sometimes you have transitions of sole traders or partners becoming an entity. And if that's the case, we always take that into consideration. But I guess I don't have a comment there. The comment, if I had one, was really, let's get selling, let's get started. And as a business, you're there to sell goods or services. And in that first sort of port of call up to 10,000, depending on your risk appetite, I would be saying, let's just get a clear adverse check on that particular company. Let's make sure there's no recent adverse. If there was, I'd want to speak to the customer about why there was some adverse there, or quite clearly, are they just going around to different suppliers credit surfing because there's recent adverse there, and how do you make sure you stop yourself from dealing with the wrong customer? So 0 to 10, a very quick check, make sure they've been around for a little while. Some of these checks can come with a score or a grade. or a tick of the box or a green light, and essentially should take no longer than a couple of seconds or minutes to implement. And then you can keep that on file for future records. Then if we're starting to step it up to, say, a credit level between 10,000 and 50,000, you want to do a little bit more in your assessment and make sure you start to think about what sort of security levels that you may have in place. So again, you'd be getting a clear adverse check. I would extend that to look to at least ask them to give you some trade referees to make sure that you know that they're paying some other people. If they're looking for a credit level up to 50,000, they should have perhaps been around for a little while. And if you can't get trade references from them, you can step up your credit adverse check to a trade report, which then will incorporate some other trade information from your sector to also highlight if they've been trading with other suppliers and if they've been paying on time or not. I mentioned here that when you're getting to this 50,000 mark, you should consider lodging a registration on your security interest on your goods if you're selling goods via the PPS, the Personal Property Security Register. Now, for those of you who may not know what this is, essentially, if you're supplying goods to a customer, if you're not registering your security interest, it is a gift to the customer until they pay for it. And if they don't pay for it and a liquidator or administrator comes in, they will take those goods as a gift. You no longer own that. And even if you have retention of title or terms within your terms and conditions that says you own those goods until paid for, you need to still register that security interest through the Personal Property Securities Register. Now, there's different methods of doing that. And essentially what this does is that if a customer isn't paying you, you have the ability to say, you haven't paid me, I want those goods back. Or more, what happens is there is an administrator that's appointed or a liquidator appointed, and that gives you the opportunity to say, I supplied these goods, they haven't yet been paid for, I have a security interest, I want those goods back. Now, if they've been sold or even if they're co-mingled with other stock or products, you can use the security interest as a way of discussing or negotiating with the administrator to get some level of payment back. So it is a good tool, and we'll be talking about this more in Seminar 2 about how you can protect and secure your payments and your products. I make a comment there also about continuous monitoring. So as Prudence said, there are different ways that you can make sure that you monitor your customer against any changes. Let's just say you're a supplier and you have a warehouse, and I'm sure within your warehouse you have security cameras that make sure that if someone was to come in and steal your stock, or you keep an eye on your stock to make sure that those assets are secured, and that you know if something is stolen, you have some vision, I guess, or it's a deterrent that if you've got security cameras that someone may not steal that stock. Likewise, you should be having a security camera over your customers and your debtors. And a way of doing that is through the monitoring service that are available that will alert you immediately if there's a change of directorship, or if there's an adverse collection or a court action, you'll get alerted straight away. And then you can decide what you're going to do with that customer if you've got that alert. So something's changed, you have the ability to speak to the customer. You may have seen that their payment pattern has changed, but at least it's giving you an early warning sign to make sure that you're going to act on some sort of adverse information. And here, I also make mention that you should probably put, if it's a new customer and they're at that low level, just have another look after 6 months to see how their payment pattern has been. One, to see if they're paying on time and that they've been a good customer. Perhaps it's a chance to go back to them and say, you know what, thanks for paying us on time. You've been trading well. We can up your credit limit to now 75,000 based on that trading experience. And then you can look to sell more. And I'm sure your sales team will be happy with that. Now let's look at a customer that may come to you and look at a credit limit between 50 and 100,000. Here I'd be stepping it up to not just a clear adverse check. I'd be looking to get a full company report at this stage, which incorporates also looking at what the directors of that business and whether they've had any prior experience, whether they've had any prior companies that have become insolvent, or whether they have any other encumbrances on businesses that they may own. And again, look to register your security interests. As well as continuous monitoring, I reckon you should implement a biannual review. So every couple of years, just check out what's happening on these customers. And again, not only for making sure that they're paying you on time and they've been good customers, but also with the ability of perhaps increasing their credit facilities that they have with you. When you're stepping it up to the next level of 100 to 500,000 as a credit level, well, again, I'd be saying also step up the sort of report you're going to get. So it would be a full company report. It would be including director's adverse check again individually, and a PPS registration. You definitely want to have continuous monitoring on this, and you'd want to also monitor their payment trading and trends of how you're doing that with an annual review. Again, if you've got that continuous monitoring, it's going to help you with any changes of the business, especially if you might have some security, such as director's guarantees. When you're looking at this sort of level, especially around the 500,000 mark, that's what I would recommend at that layer. And then let's look at if you're going to offer credit over 500,000 as a credit limit, then I would be starting to not only get the full company report, but I'd be asking for financials from that business, looking at a financial analysis tool or looking at it yourself within the credit team, making sure they've got the ability of paying you on time, seeing what their capital is and whether they're making profits and they have the ability to continue to make profits into the future. Also that they're financially supported, not only from internal loans or capital support from the directors, but see what financing facilities that they have. Again, get a director's report and also get that PPS registration if you're selling goods. Continuous monitoring, a full annual review, and perhaps I've put there director sign-off. Now that's a director sign-off of your company. Again, within these matrices, and especially if you're getting to levels of 5 million, 10 million or more in credit levels, typically you would have another column there to say the credit managers can sign off up to 100,000. The finance manager might want to get involved up to 500,000, and anything above that, the owner of the business or perhaps one of the directors need to sign off and check it as well. So there's just an example of a credit risk assessment matrix that might be right for your business, or putting in place something that you can manage not only new customers, but when they breach these new bands for credit levels, this is what we'd be suggesting that you do.
And just on that, Kirk, we get a lot of questions about, how would a debtor feel if they're going to have to hand over these financials at this level? My answer to that is that if they were going to take out a $500,000 loan from a bank is probably going to ask for that, plus their children's first blood. So us requesting just a financial analysis is more than fair and reasonable. I often find when I actually ask debtors, can we have this information? They say yes, absolutely. So don't be fearful about asking the question. You might be surprised on the positive answer.
Yeah, and if they were to go to their bank and ask for a $500,000 loan, they definitely would have to provide their financials, and the bank would want it secured. So with a trade supplier, you're giving them free credit. And I guess if they want free credit, then they need to be able to support that they can justify that. And by providing financials, especially at those higher levels, is a good way of doing it. So I guess we've laid the foundation. We've looked at the economy and how that's tracking. We've looked at some of the matrix assessment tools that you can put in place when you're onboarding a client. But what are, I guess, the four major elements of onboarding a new customer and how you would establish that first credit level? Let's just quickly give a bit of a summary here. So Prudence, take us through this.
Thank you very much. So the first one is make it easy to offer the new customers credit. I come across a lot of credit application forms that sometimes have been taken from other businesses and they're like War and Peace. They may not necessarily have to be War and Peace. So let's have a look at them and let's make it really easy. Another way to do it is, of course, put these credit application forms online. So they might be able to get into your website, they might be able to fill out the form, then it goes into different sections and bang, your credit limit is approved. It can go off to the adverse checks and come back to you. So really have a look at online application forms because that might be a really easy way for you to engage with your customers. As we discussed just in the previous slide, have that robust credit assessment matrix. Don't treat all accounts the same, because they're not the same. And the amount of credit that you're granting needs to be seen in different ways. So have a look at the information that you're requesting and the approval levels, because again, this might help you in making those decisions faster for the sales department. Make it clear. Communicate your terms and conditions to the customers in writing. Education is the key with this. When we see debtors not paying and we start to react and they don't understand, that's usually when they throw all the toys out of the cot. When they're understanding of our processes and see it actually coming, having that clear communication and putting it in writing, 9 times out of 10, the conversation is very, very different. And then the last point, which is extremely important, monitor and review your debtors. Make sure that if they are going to change anything to do with their company details or they have any adverse information, that you're aware of it. So then you can make the most appropriate decisions for your business.
So Prudence, when we look at these 4 points, it basically is best practice of how a credit team or a business can make sure that they're giving themselves the foundation when they're treating or they're assessing new customers or working with existing customers, that they're going to protect themselves the most in when they're starting to deal with a new customer who wants credit terms from them. So just to quickly go over this again, the terms and conditions you've said, make sure we're going to review them on an annual basis. There are different privacy rules or different trading rules that come into play, so make sure you're getting those reviewed. The online credit applications gets the information the right time, and I'm sure you have sales team that come in with a post-it note and says, hey, I need to send $20,000 worth of goods to this customer tomorrow. This is what I think their company name is. If you're getting it done online and the customer's filling it out and there's links to those adverse reports through that process, they're going to get the right information the first time, and it stops you going back and asking more questions, and it makes them easy. It makes it easy for them to work with you and opening a credit account. And you mentioned there about make it clear in writing, and what we see is a number of customers don't write back to to their new clients in saying, here's your credit limit. These are what my terms and your terms are. This is what you agreed to. And at least have it there that when you do need to follow up someone who hasn't paid you on time, you can bring out that letter and say, hey, remember when we wrote to you, we said you had a credit limit of 15,000. We said you had to pay within 30 days. And we need to be able to initiate this, and we will take collection action. And they've got it in writing, so it's not like they didn't know about it. And especially when you are moving it to legal action, having that letter is going to definitely help you in the event of trying to get those recoveries. So don't set and forget, have these things in place, keep an eye on your customers, assess them in that level of review matrix, and you're going to set yourself a great foundation for your credit team and what you might need to do in the future.
Absolutely. So, Greg, we've got a couple of questions here.
Okay, excellent.
Please put your questions through in the chat if you would like, and we can go through them when you're ready. Kirk, sorry, did you want to say something?
No, I was just going to say, so this is the first seminar of 3, and we've got a QR code there if you'd like to register for the next seminar. And as I mentioned, that's going to be around more around the security and the protection mechanisms in your credit risks and the products available for that. This has more or less been around the initial setup and assessment of credit risk and how you can build that foundation. We've tried to keep the sessions at around about 30 to 45 minutes to help you with just the timeframes. And as we mentioned in the launch of this through the CreditWise Academy, is we will be giving you a certificate at the end of these 3 sessions to make sure that you have something to say, hey, I attended these and I understand the different layers and parts of credit risk and how to be a great credit manager. We've had 750 registrations for this CreditWise Academy, so there's a lot of interest in making sure that there's good practices in place. But let's move to some of the questions.
Thank you very much, Kirk. Now, there's quite a few questions about PPSA, which is,
Okay.
the part we're going to cover that in the second webinar that we're doing for the CreditWise Academy, because that'll be all about security and, what we can do to really securitize the account moving forward. But some really good questions here, Kirk, about how PPSR really is applicable to services. Can you just go over what the advantages are and if they should actually be looking into registering, please?
Yeah, so the PPS is about registering your security interest on products and goods that you might be selling to your customers. With regards to services, it doesn't account for services. Those services, it's not a tangible product, so therefore you can't register a security interest on a service. So it only relates to, and the Act only relates to, actual physical products that you're selling. Or you also need to be aware that the Act can or does cater for things like if you're selling beverages to a pub and you also give them fridges to put those the beverages in, and you let them have those on their site, you need to register those fridges, because in the event of an administration, the administrator will take those fridges if that's not registered to you. Likewise, if you're selling fuel and you put pumps into a service station, any assets that you put on site, a storage tank for goods, you need to have registered. Same if you're hiring out tractors or machinery, you need to have registrations for your security interest on that. Anything that's outside your property, I would suggest you have a security interest on through the PPS register. Prudence has gone silent.
She's muted.
Prudence, you've just muted yourself, actually.
I don't even know how that happened.
Well, we can hear you now.
Apologies for that. I've got a question here from one of the attendees. In the past, we've issued T's and C's when supplying goods, but have not had these signed and returned. Could this be an issue into the future?
Yeah, it definitely is. I mean, it's better than not sending any terms and conditions to say, well, by way of asking for goods and the fact that we've supplied, and a lot of people used to put their terms and conditions on the back of an invoice. They've accepted your terms and conditions by way of a transaction and then paying. But it's always great that in the event of a collection or legal action, to be able to say that our client has acknowledged this, whether that's an online form that they signed through DocuSign or they physically had a wet signature that they've signed on your terms and conditions. That's going to be a lot stronger than just saying, but our invoices had terms and conditions on the back of it, versus having a signed terms and conditions document that we can put in front of a court or put in front of them when we're taking collection action.
Yeah. I've got a really good question here. What happens when the customer has their T's and C's, so I'm guessing the attendee means contracts perhaps, for suppliers, and say they will override ours? Whose comes into play there?
Yeah, you need to be pretty careful of that, because if I was a supplier, I wouldn't want to say that these are my terms and conditions and you need to sign off on my terms and conditions. You want goods from me, but if you want goods from me, you're going to have to accept my terms and conditions. We understand that there's certain larger, mainly customers, who may say, I'm funding these goods. So when you supply them, and a typical example of this might be if you're supplying a major retailer with TVs or other product fridges, they're going to say, as soon as you've supplied that into the store, the goods are ours. And they may cross out the fact that you can have retention of title on your terms and conditions. If they do that, you just need to be aware of it. But I would still make sure that you have your terms that they've signed, even if they've crossed some things out and initialed it. At least you're aware of that before you sell goods.
Absolutely. And Kirk, what is it that what do you do if trade references actually refuse to give out any information?
Sorry, what was that, Prudence?
What would you do if trade references refuse to give information and just won't talk to you at all or respond to your emails?
Yeah, I guess it would put up a bit of a question mark on why. Some people like references for employees or whatever will just say, look, No, I'm not at liberty to give you one on this. It may be that if that's the case, they just don't want to say anything. And I would suggest that you make sure you go and get your trade reports or your your adverse reports to make sure that you're getting other documentation to try to help you with your risk assessment in that scenario.
Excellent. And a question sort of following on from that I've got here. What type of adverse information is really important to look at? And does some matter more than others in your opinion?
Yeah, look, I think it's a way of just categorizing the type of alerts or adverse that you might get. We see if there's a director change, you might need to change your guarantees that you might have had with a director. Is that meaning they're just having if they're getting out because there's an issue, or whether they're transferring it to other family members? An adverse for a mobile phone account that may have been paid late or something like that. You can check if those things were paid. And I guess you need to categorize the level of action. If it was a court action and it was for a large amount, or more recently, you might see the ATO action, depending on the size and how it's been dealt with. It definitely gives you the ability to go and investigate those things further. And I guess it's a little bit of a flag to just say, hey, just stop and prop before you give credit here. Have a little bit more of an explore of what's going on.
Absolutely. Question about PPSR again. What's the costings involved with actually having a registration?
Yeah, so the government has set certain registrations. So you can take a registration on a 7-year registration. So it gives you 7 years worth of security interest. And there's a question that comes a lot around this. You only have to register for the company you're trading with, your customer, once. It's not for every invoice or every trade. It's just once, and that covers the entity that you're trading with. So that's there in place for 7 years, or you can get a longer time. I think there's even a lifetime, and they've got different charges. So I think the most common one that people do, it's around $10. If you're getting someone like NCI or another company to help you with facilitating that registration through a template or whatever, you're going to be looking at around $10, $7 to $10, depending on what level of registration you want.
Mm-hmm. And as Kirk mentioned, we do conduct the registrations for clients, but even if you want to have some further information about it, please do give us a call, because we do have someone in-house that is an expert at it. So we'll be able to put you in the right direction as to what's actually going to be the most effective for your business. Now, I've got a couple of questions about DocuSign, Kirk. Any thoughts on the use of DocuSign, so that's digital signatures, of course, to get agreements signed? Do you feel it stands up in court? Is it worth it?
Yeah, look, I mean, I think everybody has moved to the fact, especially during COVID, that it's more acceptable to have digital signatures rather than wet signatures. But again, it goes back to the communication piece. So if I received terms and conditions that were signed through DocuSign, I think it's pretty secure. But I would also be saying in a letter back to them, thank you for your terms and conditions signed. We received it on this date. We appreciate that you've got it signed digitally, just letting you know we've received it. And then, where there has been cases in court where a CEO might say, I didn't sign that, my secretary or PA or someone in my team did that for me, I didn't agree to it, that you can say, but we wrote back to you and you never said anything about it.
Huge problem there. And I've got a question about ABNs. Assuming there's no zero adverse, etc., on an ABN, are you happy to always go to the first year being the credit at the top amount, or would you still actually do it in stages, usually with the first dealings with a customer?
Yeah, look, again, this is about communication and transparency. If it's a long time ago and it's been paid, and it's on that same company, then I'd be, whether your credit team would ring the customer and say, hey, I just wanted to get a bit more information about this default that was there 5 years ago. Or if you're satisfied that it's been paid off, and depending on the amount again, then you might let it go through, and you might sort of say, but I'm only going to open this account at the lower level, and we'll see how they trade and we'll grow it over time.
Now, I've got a question here that we might need to get back to this particular attendee. However, they're saying, are the T's and C's on the website taken to be accepted if a customer is referred or directed to them? So I think that this is also the question in relevance to if we make changes, therefore on the websites, is that then debtor beware and they should have actually read it from there type of question?
Yeah, I mean, I guess I would be just reviewing it and checking out the information and going back and seeing what changes it and whether it's a significant change or just a basic change.
Okay, excellent. I'll also write to that particular attendee. If you want to contact me afterwards, we can have a further conversation about that. We've got a lot of questions here, so I'm just trying to get through a couple of them. There are some that we might need to write back to everyone. Thank you so much. I'm loving all these. We've got now 37 questions, so I'm just going through them. But another one that's come through here is, currently all the suppliers pay COD. Why is it that I need to offer credit? Why is it really important? Kirk, would you like to go through that?
Sorry, Prudence, I just got handed a note to say that we will send a copy of these slides and a Q&A and our answers of them back to everyone. So if they're wondering and they're trying to madly write down some things, we will send a summary with those questions and the answers with this. Sorry, can you just repeat that question?
The question was in regards to offering credit. Currently, all the suppliers are paying COD, and I suppose to move them then onto terms, is this something that they should be doing?
Yeah, absolutely. I mean, I would look at the fact that if you're going to grow your business, offering only cash payments may be restricting your trade or the customers wanting to trade with you. Even, with a number of our customers who will offer credit card payments, they still sort of say, look, I'm sick of coming into the store and having to pay on credit card. Can you just open a credit account for me for 10,000? Now, if you made that process easy and you're a preferred supplier outside of just the terms that you're offering, then they might come in and buy more product for you. And again, you might want to look at, well, how do I protect myself if I'm offering credit? Do I need to get security interest through PPS? Do I need to get credit insurance? Do I need to get some sort of security? But I definitely feel that you're going to make your business more competitive in the market and also give yourself the ability to grow if you are offering credit terms.
Absolutely. So question here about agriculture. We've got an agriculture commodity broker joining us. Thank you very much. How can they protect our selling farmers for default against a buyer who's taken ownership of the commodity on credit?
Yeah, so again, agri is one of those really interesting sectors where payment terms can be over a year. The products are handled or bought in bulk or pre-purchase. So you'd have to look at sort of the credit terms that you'd be offering, the futures of what, if it's going to be a paper trade or it's actual physical trade. There are ways of securing that through funding, finance, and also through a credit insurance product. Typically, if you're looking at days greater than 360 days worth of credit, and that sometimes does happen, even though there might be installments, a la fertilizer payments or terms, you might need to look at sort of a more bespoke way of covering that credit or offering the credit terms and how you get the security interests along the way.
Yeah, absolutely. And if I've got a couple of questions about adverse, and I'm going to try and roll them into one. If a customers do have adverse against them, whether it be judgments from other suppliers, but they still want to trade with them, would you think it would be a good idea to sell on a cash basis? And then how long would you sell on a cash basis before you feel it would be comfortable to then set a credit limit?
Yeah, I think the typical sort of time frame is about 6 months. And businesses who are opening an account and they sort of say, look, there's been a few things that we're not convinced that we can open a credit account. Let's start off at a lower level. Let's see how you trade for the first 6 months. And we promise we'll do a review after that time. And again, you might have to weigh up whether they're going to competitors or if competitors are offering credit terms as well. But typically around that 6 month mark is where people like to see a bit of trading history before they start offering larger levels of credit.
Thank you. And in regards to, this is a really interesting question, actually. Is the legislation in place for default registrations at the moment, as in the ATO defaults? And have you heard if the insurers are withdrawing credit based on this?
Yeah, extremely topical. And the answer is not every situation is the same. So as a general rule, the insurers and I guess businesses are looking at ATO defaults and saying initially, what are we going to do about it? We now know of this information, and keeping in mind it's only for defaults above 100,000 and businesses who have not engaged in any way with the ATO on these tax debts to offer a repayment plan or anything. It's only if they've not engaged with the ATO and it's above 100,000 that they're being reported. So it's fairly significant in my view, but there's always situations behind different things. And I guess if I receive that alert, I would want to speak to my customer. I'd want to say, hey, what's happening? Can you give us some feedback? Are you in contact with the ATO now? And I guess this is the whole point of why the ATO has ramped up their reporting out in the marketplace, because they want suppliers to put pressure on the customers or the businesses that have not paid their taxes to engage with the ATO. And as far as the insurers go, there are some insurers who will take the view of saying, we've got this alert, our initial reaction is to reduce the credit that's insured. Others are saying we're exploring it or we're investigating it, or we're putting the onus on the supplier to make sure they speak to the customer. And in the event of an insolvency or a claim, you need to show us what you've done to make sure that you tried to mitigate any loss with that customer. It might be that you put them on stop for a week while you ask for them to come back with some feedback on why the ATO is reporting them.
Absolutely. And that sort of flows on to another question that we received in regards to, do you recommend trading with customers who have large ATO defaults? As Kirk said, I think it really comes down to the communication that the debt is actually going to provide to you, what the circumstances are. I feel that open and clear communication is the best way for you to make those sorts of decisions, and depends on how big it is. As Kirk said, the market is really responding to debts that are over 100,000 where they aren't having that clear communication with the ATO. I think it's fair and reasonable for you guys to make decisions around those levels also, and what's adequate for your business.
Yeah.
Now, I know that
I'll just add to that, Prudence. We mentioned the term credit surfing, and this is where a customer or a debtor is on stock with some other suppliers, and they start surfing the market to see who they can get credit from. And it's why it's so important that you do that initial credit check or review to make sure that there's any alerts out there or collection actions, legal actions to tip you off. And if you are using a monitoring service, you can always get onto a database. NCI has our database. With our clients, they can hop on, they can search the data, they can see if there's any adverse before they even start engaging with the customer on whether they want to start an assessment or go forward with looking at whether they're going to offer them credit. Sorry, you've gone on to mute again.
There's like a little computer fairy that keeps on doing this.
Got a
because my hands
gremlin
aren't even
there.
touching anything. But however, when you're opening up accounts, Kirk, and you get a lot of applications in that could be under trusts, what is your feeling around that? And how do we make sure that we're covered in the correct manner when it comes to trusts?
Yeah, this is a really, really typical scenario that we see. And essentially, you want to be dealing with the trading entity, not the trustee. And sometimes even the customer or the debtor, they don't know what they should be declaring on a credit application form. And this is why some of the online credit applications forms are such a good tool, because if they put in an ABN that links to a trust, it will pop up and say, thanks for your credit application. We've noticed you've put in an ABN that relates to a trust. We actually need your trading entity as part of what we're going to do business with. And it stops that back and forth or maybe incorrect way that you're invoicing a customer into the future. So if you can get it at the pass in the first time of making sure that you're speaking to them about we need to deal with the trading entity, not the trustee, that's a way of making sure that you cut that issue off at the beginning. But it is quite a typical one. And you mentioned the 27% of people who are not knowing who they're dealing with when we wash an entity. The majority of those 27s are either insolvency, 27% is insolvency, or trustee companies, which are not actual trading entities. Now, Prudence, we are coming up to the hour mark.
Yes.
And we're happy to keep going, but we just wanted to make sure that people knew this was for an hour. We will send through the Q&A and our answers as well. Do you have a couple more that are quite common?
I think that the others that we can go through, I think we're best writing individually to these people because it's more bespoke to their actual business. But I would also like to mention, as Kirk said, we will be sending this webinar to all of you within the next week. And so you'll actually receive this. We're not having a diploma. There's been a couple of questions about a diploma. No, this isn't a diploma type course. However, you will get a certificate of attendance after the 3, I believe, Kirk. Is that correct?
Yeah, that's right. Absolutely. And, I guess there's other bodies and we're part of, or we are members of the Australian Institute of Credit Management. They are a great body for, credit professionals who may want to step up and go from this sort of seminar type environment to something which is more of a certification. They can definitely get onto the AICM or the Australian Institute of Credit Management, and there's some courses there that will be very well suited to people who want to become credit managers or go a little bit deeper in that field.
Absolutely. And as Kirk mentioned earlier, this is one of 3. So,
Yes.
Next time it's really about the securities. So all those people that have got lots of questions about the PPSA and guarantees, please do come to the next one. And the third one's about collection of the debt and protection. So it's really important to come to all 3 so you can see a really good, outstanding process. And I think it will answer a lot more of these questions. We do have one more question that I think we should answer. In the event of a client who has executed a clear and binding agreement, so they've signed the credit application form, they've done the credit checks, they've all come back great, no adverse, yet unfortunately they haven't actually paid, and then they've gone missing. We've got a CEO that's gone into hiding. What do you recommend for this type of situation, Kirk?
Yeah. So, fortunately, these are not very common. And I guess if you've done some checks, it's going to be highly unlikely that you do one trade and then they go disappear. But it does happen. And in these cases, unfortunately, what you're going to have to do is get a skip trace person involved to go and see if they can find the debtor. Hopefully, you can get an address of the director and you'll have to serve some documents. And if worst case scenario, you go to a local court and you have to put in an action, you're more than likely to get an undefended judgment, which is then going to allow you to at least take some sort of action. And if you have a credit insurance policy, or if that was an insured debt, then you would need to be able to you'd get that undefended judgment and then would lodge a claim on a policy. But yeah, hopefully unlikely that happens if you've done all the due diligence. But, I guess it can happen, and it would be an unfortunate scenario. But yeah, there's obviously ways that you'd have to deal with that from a legal perspective.
Absolutely. And
so, Prudence, make sure you're getting your phone out and you're scanning that QR code to register for our next seminar. If you know of other people that you think within your teams that might want to join the next seminar, we'll make sure we've got plenty of time for more questions next time as well. As you say, we'll be looking at the security and protecting your risk elements next time. So scan that, register, we'll get it out to you, and we look forward to seeing you next time. Thanks, Prudence.
Excellent. Thank you very much. Speak to you guys soon.
Bye, everyone.